Hello everyone, welcome to the very last video that we have for FM Pre-September 2024 mock exam. We are solving the very last question, Coral Company, in this mock exam. So let's get started. I see a very first requirement of 8 marks to calculate the nominal NPV of the project Catch the Hatched and comment on whether the project is financially acceptable. Here is the information that we require to do the calculation. So let's read the scenario. Coral Company is engaged in selling computer games in the country of Ireland. Recently, it spent $125,000 on market research to evaluate the possibility of success of its newly developed game called Catch the Hatched. Encouraged by the results of the survey, Coral Company has decided to launch the game in the near future. The estimated sales volumes are as follows. So for 4 years, they are given the quantities. Then the current estimated selling price is $35 and is subject to the inflation rate of 6% per annum from the first year onwards. Variable costs at current prices are estimated at $23 per unit and would increase at the cost of inflation rate from 4% from the year 1. Nominal incremental fixed costs are expected to be $750,000 for years 1 and 2 and $800,000 for the years 3 and 4. Now, the initial investment of $3 million will be paid immediately, and the useful estimated life of the game is 4 years. The tax allowable depreciation will be 25% on the reducing balance method. Balancing allowance will be available for a claim at the end of year 4. The project will have a zero realizable value at the end of the 4-year period. Coral Company pays the tax at 25% and the tax liability is settled in the year in which it arises. While Coral Company uses NPV method to appraise, to evaluate the capital projects using a 10% post-tax nominal cost of capital, its directors feel that the NPV is only an indicative amount of wealth creation and that the NPV method has certain limitations. The volatility in the market may influence the net present value. She has therefore asked for a sensitivity analysis of this project to understand the possible impact of these uncertainties. So now we have read the question. The next step is to get on to solving the questions. So I'm going to start with year 0. 1, 2, 3, and then 4. So there are 4 years that we are totally talking about. Sales units are provided to us. 120,000, then we have 135,000, and then we have 160,000, and then we have 100,000. So this is the sales units that are going to be there. Now let's talk about the selling price. Selling price for the very first year is given to us as 35. And from the first year onwards, basically that means we are going to have to imply for inflation over this also. We are currently at year 0. So in year 1, it's going to be an inflated amount. So we are going to inflate it at the rate of 1. What's the inflation rate given? 6%, 1.06 raised to the power of the time. So I can link it over here just so that it can automatically pick up the values for us. So these are the selling prices in front of us for the sales units. Now the next step that we're going to perform is to find out the variable costs. So the variable costs also are given to us per unit and they are again in current year price terms. So we are going to have to apply for the inflation. Inflation is given us as 4%. So we are going to apply the 4% inflation. So this is what our variable costs also are going to look like in each of these years. Now let's have a look at the contributions. The contribution that we are going to get per unit is going to be the difference between your selling price and your variable cost. So that is 13.18. Now with your contribution multiplied by the quantity that we have, this will give us the operating profit. So your operating profit is going to be the contribution multiplied by the sales unit. So this is what the operating profit is going to look like for all of these years. Now the next thing that we're going to do is subtract our fixed costs. So the fixed costs are already given in the nominal terms, so we do not have to do anything about that. 750,000. For the second year also, it's 750,000. And for the next year, it's 800. So this is what our fixed costs have been given to us as. Now, the next thing that we have to do is subtract from our operating profit the fixed cost so that we have the profit before tax. So we have these figures over here as our profit before tax. Now, the next thing that we do is subtract for tax. Tax we are paying at the rate of 25% as given in the question. So I'm going to subtract equals to this figure, or I can say minus this figure, just so that I want it as a negative figure, minus 25%. So similar can be taken to the rest of the years also. So this is how tax working can be done. Now we are going to take into account the impact of our tax allowances. So let's have a look at how we are going to calculate the tax allowable depreciation. So we can do a separate working for that. You can either do a working leftwards, you can create a colored space, and from here you can indicate that you are starting your workings. Or you could do it down after you have done the calculation of the NPV. So the choice is yours. I prefer it this way. So in the year 1, the value of my machine opening balance is 3 million. So 3 million is what I have. Now I get a benefit of 25% depreciation. So equals to 25%. So this is the depreciation that I get. And then the benefit is again going to be the 25% of this figure. So into 25%. So that means in the very first year, I'm going to get a benefit of this figure 1,87500. So I can write that this will be my TAD, and I will be getting an inflow of this figure. Now the next year, my opening balance year 2 is going to look like the difference between these cells. So it's going to be 2250, and then I'm going to charge again. Formula can be copy pasted, depreciation, and then this also can be copy pasted. So the next year, the depreciation benefit is going to be 140625. Similarly, you can link this cell over here. All right. Now coming to year 3. Year 3, your opening value is going to be this minus the depreciation. So this is what now again you can copy paste the workings, and this is what you will get as the depreciation benefit. So you can again select the cell in which you have calculated. Now we have come to the last year. So we are going to have to take the end year figure and then simply take 25% of the opening figure to arrive at the final answer. And you see that the project has a zero realizable value at the end of the 4-year period. That means your scrap value is essentially 0. So you do not have any scrap value. So it's going to be the remainder that you have, the carrying value, and you're going to get simply the benefit of 25% on it. So 25% multiplied by this figure right here. So in the last year, you're going to get the benefit of this much. So this is what your TAD looks like. And now we are going to move to the operating cash flows. So your cash flows are going to be nothing but the sum of these three: PBT minus tax plus TAD. So this is what your operating cash flows are going to look like. Now the next thing that we are going to do is subtract for the initial investment. Initial investment goes out in year 0. Year 0 is $3 million. So this is what goes out. There are no scrap values given to us. So this becomes our net cash flows also. Net cash flows. So it's this figure, and for the others, we can say this figure. So these can be brought down. Now these are your net cash flows. Now you have to calculate the NPV. Simply use the NPV formula. Equals NPV. Your cost of capital is 10%. And then select all of your cash flows. Be very careful to select cash flows from year 1 till the end, and then manually add for the initial money going out. So this is what your final answer is going to look like. You can convert it to the currency format where it's going to look like $333,536. So this is what the NPV is going to be, and we are still not yet completed. They are also asking us to comment on whether it's financially acceptable. So you can highlight your answer that this is the NPV, and the comment over here will be that the project is financially acceptable as the NPV is positive. Since, accepting this project is going to give you a shareholder wealth of 343,000, this project is financially acceptable. Moving forward to the second requirement. Second requirement wants you to briefly explain the term sensitivity within the context of investment appraisal and the method of calculating it. So the concept of sensitivity simply means that in the real world, whatever assumptions that you're taking with respect to discount rates, selling prices, costs, the tax rates, they are subject to change. They do not remain constant over such a long period of 4 years. So these changes, depending upon the market factors also, there are going to be fluctuations. So sensitivity analysis is nothing but a what if type analysis. It helps you to see the impact of those changes in your profit, in your net present value. So the method is that you first take one variable at a time and then you assess the impact of any changes that happen. So for example, it could be with respect to selling price, it could be with respect to the fixed cost, it could be with respect to the number of units that you're selling. So this is how you choose one variable at a time. And then the change is determined that would, how much change would bring the NPV to zero. That's known as the sensitivity. This helps you to evaluate how risky a project is before you actually go on to take the project. This is what you will write for 2 marks. And then moving to the third part where you're required to calculate the sensitivity to the change in selling price and to the change in discount rate for 4 marks. So NPV of the project, we already know. Roughly, we can say that it was 344 if we round it off to thousands. So it was 344,000. Then we have to find the sensitivity out with respect to the change in selling price. So we'll first see how much is our, selling the revenue that we generate from the sales. So let's see the calculations here. Year 1, 2, 3, and 4. So sales units are given 120,000, 135,000, 160,000, and then 100,000. So these are our sales units. And the selling price also, we had calculated all of this earlier, but we are still going to require this into 1.06 raised to the power of the year, which is 1. So these were my selling prices. Now I can find out my sales revenue. Revenue is nothing but the selling price multiplied by the units. So this is my sales revenue. Now I'm going to have to discount this to the present value is at the rate of 10%. So the 10% factors can be 1 by 1.1, and this needs to be raised to the power of 1. So these are your discount factors. You can either take them from the tables. I find it easier to plot the formula here and then find out the total present value. So you read this figure multiplied by the discount factor. So this is what my present values are going to look like for all 4 years. Now, if you see, we also have to, convert it to the total. So let's find out the total. Total PV that we have is going to be the sum of all of these years. So this is what total you are generating from the sales. Now you are going to have to also convert it to the post-tax one, because tax you pay because sales are happening. So it's important that we make it post-tax also. So multiplied by 75% is going to make it post-tax. Now sensitivity, as we know, is nothing but the NPV divided by the value that you are comparing. So 344,000 divided by what you've worked out as your post-tax sales revenue over here. So you find out as a percentage, it's 2.79 or roughly 2.8%. This means that if your selling prices are going to reduce by 2.8%, then the NPV of the project will become 0. Then you can also say that the project is very sensitive to the fluctuations in the selling prices. Now, with respect to Now coming to solving the second part, wherein we have to find out the sensitivity to the change in discount rate. So conceptually, if you've studied, the sensitivity to discount rate is nothing but the IRR. So one thing that we can do is either we take our cash flows from the previous question, bring them here, or we can simply calculate the IRR there itself. So we have our cash flows in front of us. IRR is going to be nothing but you have to use the formula of IRR and select all of your cash flows from year 0 to the last year. So the IRR is going to work out to this figure that you see, 14.91%. So this is your IRR. Now, this is the sensitivity to your discount rate also. That means that if your the discount rate is going to increase, then your NPV is going to go down. So the sensitivity of the project, you can say, as we know, the IRR has worked out to be 15% roughly. So you can say that the sensitivity is going to be the difference, which is 15% minus the cost of capital that you currently have. Divide this by the original cost of capital, which is 10%. So your answer is 50% is the sensitivity. That means if your discount rate goes up by 50%, then your NPV is going to become 0. Now with this, we are done with this part also. Let's move ahead to the very last requirement, which wants us to discuss why the discounted cash flow investment appraisal methods are superior to the non-discounted cash flow methods. So here there are multiple aspects that you can talk about. I'm going to give you the bullet points. First is that the discounted cash flow methods consider the time value of money. As you know, the $1 that you have today is not going to remain the same 5 years later. So the money loses its value with time. A dollar received in future is worth less than a dollar received today due to multiple factors that you have, like inflation, like opportunity cost of capital. So the discounted cash flow methods are superior because they consider that the time money has time value. Then the second method, superiority is that they are based on cash flow basis. So whatever cash flows that you have, they are actually used in the DCF methods, which are, not based on the accounting profits. So these are less susceptible to manipulation or distortion of, accounting policies, depreciation methods. So they are more reliable. Next one is that they consider the whole project. Usually, the other methods are not going to consider all of the relevant cash flows, but here DCF methods are going to take into account all the entire life of the investment project, or the entire duration. And another one that you can write is the compatibility with shareholder wealth maximization. Compatibility with shareholder wealth maximization. What do we mean by this point? Now, when you say that the discounted cash flow methods are aligning well with your objective, how do they do that? Because they measure how much the contribution is going to be there to the shareholder value. For example, NPV, which we calculated, this NPV is going to get added to the wealth of the shareholders. So this is compatible with your ultimate objective of maximizing the wealth of your shareholders. So with this, we are done finally with the FM Pre-September 2024 mock exam. I hope that you find these videos useful. All the very best for your exams.